Hello, Kurt Jackson, the Safe Money Man here with today's episode of Fact or Crap. Remember, as you watch today's episode, I got to fully disclose that I have a significant bias in my thinking, and I'm all about keeping your money safe, minimizing your taxes, getting the most growth without ever risking loss, and then getting you guaranteed income that you can't outlive. If you like having your money at risk, then you're probably not going to like what we talk about here. And I do challenge any and all to show me a better way that's safe, that's tax-free, or has a net after-tax income that's at or above our plan and has a guaranteed income for life. All right, today's Fact or Crap statement is this. 401ks make effective investment vehicles, if only because your employer matches your own contributions. Is that fact or crap? Well, the research I've done has shown me that this is crap. I realize on the surface having a company match in a vehicle that you're putting dollars in before you pay taxes on them, they grow tax deferred until you retire, then you'll be in a lower tax bracket when you pay taxes on them. In the meantime, your money's either 100% at risk, or you have it in safe vehicles that pay nothing or next to nothing, so you're losing out to inflation. If you need the money for an emergency, you pay a penalty and taxes on it. If you die, your heirs get what's in the account, but will have to pay taxes on it. And not only are you at a risk at loss, you pay high fees each and every year, whether your account is up or down. Then when you get to retirement, statistics show the average 65-year-old with a 401k has an average of 149 grand in their 401k account. That's not hardly enough to retire on. In fact, less than 10% of all people with a 401k have more than 250 grand in their account. Now do take note that today's 65-year-olds, they've had 30 years to be involved with the 401k program. So that's a pretty good sample. I wanted to run some numbers based on real returns in the market. So what I did is I went back to August of 81 and took the S&P 500 results through July of 2010. There's nothing significant about that period other than that's when I did the research. We assumed $60,000 per year employee in a 25% tax bracket, putting in 10% of their pay into the 401k, and the employer matched 50% of that. So we had $6 grand from the employee and $3 grand from the employer for $9,000 a year going into that. We assumed that fees were purposely low at 2% because I couldn't figure out how to 100% accurately put in dividends from the S&P 500. Dividends average around 2% per year, but they're not guaranteed. So basically what I did is I assumed a 4% fee structure and took 2% off of it for the dividends. Now remember, this money's before tax dollars. It grows tax deferred. It enjoys all the market gains and can suffer all the market losses. We put $9 grand a year in for 30 years. That's $270,000 of your money and some of your employer's money. We ended up with $707,920 in the 401k account, which is an actual 5.97% annual return after fees. Okay. When we compared that to our 802 plan, we put in after-tax dollars, and there was no match from the employer. If we assume that 25% tax bracket, that $6,000 is actually only $4,500 after taxes. So the 802 plan is competing with half the money. We're putting $4,500 a year in for 30 years, or $135,000. Man, that really skews that toward the 401k, don't you think? Well, the 802 plan, while not in the market, does mirror market gains in the index, which is an S&P 500, up to 16%. Okay, it has a floor of 1%, so you never lose money when the market's down. We're going to assume the fees are about 2% per year. The 802 plan grew to $546,301. I know that's $161,619 less, or 23% lower, but it did actually earn an 8.38% annual return. Not bad, not really bad considering we were fighting with half the money, right? Now most would think the 401k beat the 802 plan, right? Well, the devil's in the details. See, having your money in the market means Wall Street's going to tell you that you can only take out about 4% of that $707,920 so that you have a good chance to not outlive your money. Well, that's $28,317 per year. You know what? I guess they were right. At $28,317 per year, you would be in a lower tax bracket according to today's tax bracket. It's roughly the 15% tax bracket, giving you a net income of $24,069 after tax. If we assumed a $20,000 Social Security income, your gross income's $48,317. Now the Social Security trigger uses all of your income from the 401k and any other income in retirement, plus half your Social Security income. So that number's $38,317, which for a single person, the triggers for Social Security to make Social Security taxable is $25,000 and $32,000. So in this example, we're over $32,000, so they're going to tax 85% of the Social Security benefits. 17 grand is 85% of 20,000. Tax at 15% is another 25.50 in taxes. So that means your total net income after taxes is $41,519. Okay? Well, the 802 plan gives you tax-free income with no Social Security trigger for taxes either. See, it's the only income that's going to do that according to current tax law. And since we never lose in this vehicle, we can afford to take a higher income. You might get a guaranteed income of, say, 6%. Well, on 546,301, that would be $32,778 plus the $20,000 Social Security for a net after-tax income. Because remember, we're not paying taxes on any of this money of $52,778. But wait a minute, that's $11,259 a year higher than the 401k income. Less money creates more income. It's amazing, don't you think? But wait, now, we earned an 8.38% average. We never suffer losses. Well, couldn't we then take the 8.38% out without ever touching our principal? See, that's $45,780 plus the 20 grand in Social Security. That's $65,780 for life and no taxes. Heck, on the 802 plan alone, just on that alone, it makes the 802 plan better than the 401k. It's the other benefits that makes the 802 plan twice as good as the 401k plan. If you want to know those details on those benefits, contact me. I'm happy to share them with you. I'm just trying to keep this a little shorter. So even though the 401k had twice as much money, it still provided a much lower income in retirement, and it's not guaranteed to last your life. Wouldn't you rather have an 802 plan instead of the 401k plan? Hey, it's not that difficult to do, and we can help you with that if you'll just pick up the phone and call Kurt Jackson at 816-582-5532. That's 816-582-5532. Or email me, Kurt, K-U-R-T, at kjfinancialonline.com. That's Kurt, K-U-R-T, at kjfinancialonline.com. Thanks for playing Factor Crap with us today. We'll keep you posted on when we'll play again. Have a great day and good luck to you.